Hello everyone, welcome back. In this session we are going to discuss about SAP balance sheet evaluation. So first of all, the objective of the balance sheet evaluation is the calculation of material prices for subsequent use in external or internal balance sheet. So basically balance sheet evaluation means evaluating the price of the material used. So typically for valuation of the stocks of the current asset, it is a financial statement that summarize the company asset, liabilities and equity for the specific period of time. Now what are the company assets, liabilities and equities? So company asset is an item of value owned by a company. So business asset can have many categories. They can be physical tangible goods like vehicles, real estate, computer, office, furniture and other fixtures, or intangible items like intellectual property. The liability is typical an amount owed by a company to a supplier, bank, lender or other provider of goods, services or loans. Liabilities can be listed under accounts payable and are credited in the double entry bookkeeping method of managing accounts. Now, what is equity? It represents the shareholders' stake in the company, identified on a company's balance sheet. So, equity is ownership of asset that may have debt or other liability attached to them. Equity is measured for accounting purpose by subtracting liabilities from the value of an asset. At the end of the year, net profit or net loss will be moved to the capital account in the balance sheet. So basically there are three types of balance sheet evaluation. So we are going to discuss all these three types in detail. First is lowest value determination. Now what is lowest value determination? It's actually based on the principle of lowest value having the minimum value to evaluate a material for the balance sheet purpose according to the principle of lowest value. Now what is lowest value principle? It is a method of valuating. Now what is valuating? Valuating means giving some value. Okay. So lowest value principle is a method of valuating material stocks for balance sheet purpose. Okay. To give the value to the materials for the balance sheet purpose. The aim of this method is to evaluate, or you can say provide value to the stocks as accurate as possible. You require various physical inventory prices. These prices are used to calculate the value for balance sheet evaluation. So the system provides various procedure for lowest value determination. You may include these types of four value determinations. First is lowest value determination based on market prices. Second is lowest value determination based on range of coverage. Third is lowest value determination based on movement rate of the product. Fourth is lowest value determination, that is loss free valuation, in which there is no loss. So lowest value determination, we can understand it on the basis of these two examples. Profits that exist solely on the books as a result of changes in the market prices are to be avoided. That means the profit that exists due to change in market price, that is basically to be avoided in this lowest value determination. We can take one example here. If a material is produced at a price of $10 and the current market price is $15, then a profit of $5 would therefore be expected for each unit of measure, but this profit should not be included in the balance sheet until it has actually made. Okay, until we will make the profit of $5, we could not include it in the balance sheet. So the material continues to be valuated at a price of $10. It would be considered that the price of the material is $10. Expected losses are included in the balance sheet. For example, if a material is procured at a price of $10 and the current price is $7, then this loss is to be included in the balance sheet. So the material will be evaluated at $7. The second type of balance sheet valuation is LIFO. LIFO stands for last in first out. So this type of valuation allows you to separately evaluate the increase in stock of a material for various settlement period. Okay, for the financial year or for financial month. You can use various procedures to evaluate the increase for each financial period. For example, the average delivered prices. Now, what are the features of using this valuation method? It is based on the assumption that the last stocks of a material to be received are the first to be consumed. Okay, so the stock that is received at last is considered to be consumed first. So no value change occurs for older stock when new stock is received or consumed. This ensures that increase in prices do not lead to an overvaluation of older stock. So it prevents the buildup of fictitious profit. If an increase in stock is recorded for a material in a settlement period, then a layer is created for the material for that particular settlement period, and it will record the value of stock increase. Third is if a reduction in stock is recorded for a material. Now previously it was if an increase in stock is recorded. Now if a decrease in stock is recorded, okay, then what I have to do? The layer for the various previous settlement period is reduced. If that layer is not sufficient, then the layer from preceding settlement periods are reduced. Which sheet valuation is FIFO, that means first in first out. It's completely the reverse of last in first out. Okay, so it is a method of valuation that enables you to evaluate the stocks of a material in a real time manner. Okay, in a real time. So it stands for the assumption that first stock of a material to be received is to be consumed first. Okay, the stock received first is to be consumed first. That is, it is known as first in first out. The value of stock is therefore calculated based on the last stock received. So it has various uses that are discussed as below. First is it has the advantage of listing the FIFO value of certain materials. On FIFO valuation, the system calculates the FIFO value of every material. The results are displayed in the form of list that contain these types of information: the closing stock quantity and closing stock value of each material. Okay. Second is the net value based on the lowest value determination. Using first in first evaluation is lowest value comparison of the FIFO value after determining the lowest price. When you run FIFO valuation, you have to specify whether the system should also carry out a lowest price comparison. Third is updating the FIFO price in the material master record. When you run FIFO evaluation, you specify whether FIFO price should be updated in the material master record or not. Okay, so you can use the tax and commercial price field for this. You will get to know about these things in detail while the practical part in the lab. Okay, so next is reevaluating the material, that is replacing the current value of the material with the first in first out value. When you run FIFO evaluation, you can change the material price directly, or you can generate a batch input session to affect the price change. Now, what are the results of balance sheet evaluation? After using the techniques to evaluate the balance sheet, what are the results of that? In balance sheet valuation, material prices are calculated. In actual, material price is to be calculated using the balance sheet valuation. These material prices are updated in various ways and can be displayed. In each procedure, there are two fundamental different options to save the resulting price. First is change the material price. Second is updating the physical inventory price. Now, how the change of material price can be done? The prices can be adopted as a new valuation prices for the material using the price change transaction. That means using the three techniques of balance sheet valuation, we can assign the new price to the material. Accounting documents containing posting to the stock account and an expense account are created when this happens. Second is update physical inventory price. The prices can be written to the physical inventory field in the material master. The physical inventory prices have a temporary nature only. That means they can be updated. Okay. So once their content have been analyzed, you can reset the price of the physical inventory in the balance sheet valuation. No documents are posted when the physical inventory prices are updated. They are automatically updated in the existing document. So this was all about balance sheet and balance sheet valuation. In